Okay, so the next section we're going to look at is the income statement. So just some overall formatting points here before we dive into it. Any line that's a subtotal, so adjusted gross profit, adjusted operating income, pre-tax income, adjusted net income, it's nice to have those lines in bold so they stand out, and also to have this top border, so it just adds another level of separation from the items that came above it. All right, so again, everything here that's in blue going forward, this is what we are forecasting. And then if I didn't mention it in the previous video, how far out you want to forecast, I guess really depends on you. For a company like Office Depot, I think at least a year and a quarter is okay. If it's a company that has maybe a new product or a new segment coming out, but it's not going to be, on the market for at least another year and a half, 2 years, then obviously you'd want to forecast a bit farther out to see what the company is going to look like, once all the components come together. But for a company like Office Depot, 5 quarters is okay. So our total revenue numbers here, remember this is just coming from what we did in the last video where we calculated the different revenue for each of the segments above and we just added them together. Our assumptions here are that adjusted gross profit is going to be 24% of revenue, and then that our adjusted SG&A expenses are going to be driven off of this amount. One thing to point out, so the model for every company is going to be different. So while you can use this as a template to have your revenue, your gross profit, operating income, pre-tax income, adjusted net income. So every company obviously is going to have those line items. But a lot of the things in between are going to be different for your company. So maybe the company you're looking at has no other income here. If they have no debt, then you wouldn't have this line here, the interest expense net. All right, so you need to modify, the template to fit whatever the company that you're looking at is reporting. So you have these assumptions, 21% tax rate, the number of shares outstanding, 518. And so then based off of this, what you can do is you can calculate the forward PE. And the forward PE, you can calculate it two ways. You can either do it from the earnings per share, so this line here, or you can just calculate it directly from the net income and use the market cap. And so that's what we have here. So remember this information here, the date and the current price, that's being pulled from our section at the beginning of the model where we enter this basic information up here. The forward net income, you can see, is going to be the sum of the net income of basically all of 2020. So from first quarter 2020 to the fourth quarter of 2020. That's what our forward net income is. And then this gets divided into our fully diluted market cap, and that's how we come up with our price to earnings ratio, our forward price to earnings ratio. And so then to come up with your price target, what you would do is you would come up with a target PE, which you think the company should trade at. So we'll have 8 here, for example. And then using the target PE and the forward net income, you would calculate your expected market cap. And so we get 1.792 billion. So this represents 25% upside from our current fully diluted market cap, which gives us a price target of $3.14 per share. Now, one thing that it's nice to include either to the side or underneath your income statement is what the consensus numbers are. So you always want to do your own estimates, but it's nice to kind of gauge, where you stand in comparison to the the Wall Street analyst consensus estimates. So here we have for the fourth quarter and the first quarter of 2020, we have the number of analysts that submitted estimates, the average estimate, the low estimate, and the high estimate. And so you can use this to compare, to your estimate. And if your estimate is a bit different than this, it doesn't necessarily mean that it's wrong. You just need to have a reason, for why your estimate is deviating so much from the consensus. And then here also we have the consensus price target. So you can compare that to your price target estimate. Now again, every company is going to be different. So Office Depot, they do have some adjustments to their GAAP figures. So they also report non-GAAP items. So that's why we have a reconciliation section down here. If a company doesn't have any non-GAAP reporting, then you wouldn't need an adjusted line for gross profit. You wouldn't need an adjusted operating income. It would just be the GAAP figures.